Hi there to all my financial freedom seekers the universe over. This is Matt Ramey over at MoneyByRamey.com, where our goal is to teach financial freedom to the universe. So yeah, I was doing some dividend research here this afternoon, and I was going to do a blog post on it, but I figured I wanted to start getting into a little bit more video, some podcasting, so I figured, hey, I'd give this deal a shot. So I'm going to run through a quick update here on a stock that I've been following, Kraft Heinz Company. KHC is the ticker. And kind of how I started my process is I go to the Drip Resource Center, which I haven't been there yet. Google Drip Resource Center. It's fantastic. I download the Dividend Champion spreadsheet, Excel format. I have a special dividend spreadsheet that I input that information into. It kicks out some numbers, and that's kind of what I look at. That's called a screener. It's something that just kind of makes it easier for me as an investor to instead of looking at hundreds of different stocks. It kind of narrows it down to the ones that I'm looking at. I can sort, I can do different things like that. So I'll run you through that process a different day. I just wanted to kind of give you a couple of my thoughts here on KHC right now. I was looking at it on the screener. It's produced once every single month with the Dividend Champion spreadsheet, and that came out 7/31/18. And when that came out, KHC was trading at right around $60. It was interesting because I'm looking at the stock now, and I show that at 64.48, it's up 5.08 in after hours or weekend trading. And so I was like, okay, what's going on here? I saw they had an earnings report that came out 8:30 or 8:03. Looked like it was pretty good. Investors were happy. They thought it was a good earnings report relative to maybe what they were expecting, and they also believe that the Kraft Heinz might be a merger and acquisition candidate. So that's driving up the price, and so I said, hey, let's look at this as a potential candidate for investment. So I'm going to go over here now to the SEC.gov. You can't see my screen. I'm on my tablet over here. And I'm going to do the interactive. I put in the ticker, KHC. You can get financial statements on any public company. It's fantastic to go in there. And I decided to go to the interactive section. And kind of what I look at are the three main documents. And this is just, again, my quick and dirty to see, do I even want to consider an investment in this company? And here's what I look at. I first go to the income statement. And I'm looking at here, and I'm checking for profitability, basically. I'm showing that they had $13 billion in sales through 6 months ended June 30th, 2018, which is, it's a number. I don't really care about that much unless you see a decline. But the biggest thing is that they're positive net income. Net income went down a little bit. That tells me maybe margins are getting squeezed. Maybe some market competition is coming out there that's taken away from either the Heinz ketchup or some of the other products that they produce. But overall they're profitable. I like to see that. That's my quick and dirty on the income statement. So now what I'll do is I'll go ahead and I'll go over to the consolidated balance sheet. And from here, basically what I'm checking for is working capital, debt to equity ratios. How much cash do they have on hand? Basically, liquidity and debt. I'm interested, can this company sustain itself in the long term? So when I'm coming over here, I see that they have $3.4 billion in cash. That's quite a bit of cash. That's really nice to see. But they're also a mega company. They have $122 billion in assets. When you look at that, I mean that's a lot. So that cash position isn't that big. You need to have a pretty sizable cash position to sustain a company like that. So I'm looking here, and typically what I'll look at next is I'll look at current assets over current liabilities. Right here they have about $9.5 billion in current assets. Current liabilities is $9.1 billion. So that's not much of a spread there. It's over 1, the ratio, the current ratio. But it's not, maybe not necessarily ideal for me. So that's kind of a little bit of a red flag. Like they don't have that much cushion as far as with their current assets covering the current liabilities. And then what I'll go and do is I will come in here and look at the overall debt. So I'm looking here. It looks like they have $56 billion in total liabilities. Okay. And they have $66 billion in total equity. So that's actually a really good debt to equity ratio. That means that they could handle more debt if they needed to. Not that I like to see companies take on debt, but it's definitely not concerning. Anything above the 1 level, I mean, I'd be okay with that. When they start to get 2, 3, multiples of 2, 3, 4, that's when I'm like, it might not be a good dividend pair. It might be a good growth prospect, but probably not a good dividend pair. So, all right, so I'm kind of interested. There's kind of a couple red flags. I don't know if this is quite at the value point that I want to invest in right now. So now what I'll do is I'll come down to the consolidated statements of cash flow. And this is the biggest one that I look at because this Like I look at income statements can be manipulated through cash, non-cash expenses. Balance sheets are pretty nice. I like those two because it gives you the debt to equity, it gives you the working capital. But I feel like they can be more manipulated than a cash flow statement. A cash flow is going to basically give you the quick and dirty. It's going to say, did the company generate cash? If not, how did they fund a deficit, or how did they fund some financing opportunities? And I'll explain this all later. Again, this is kind of for a high level deal. I'm going to make a course on this so you kind of understand it a little bit more and hopefully get into teaching a little bit more. But basically, when I'm looking at their cash flow statements, I show that, again, we go back to that net income number. That's where everything's off. 1.7 billion in net income, which, again, that's decent. They have pretty thin margins for a company their size. But, hey, we'll take it. When I'm looking on here, I get concerned. Because here's what I see. As a dividend investor, I'm not saying this company's going to go down anytime soon, but as a dividend investor, I get concerned. They have $229 million in net cash from operations. So that means that at the end of the day, when you add back in non-cash expenses such as depreciation, maybe some intangible type assets, and then you also figure out, hey, did they collect on receivables? Did they extend suppliers out a little bit more? It gets you a sense of they're not making much cash, which is not necessarily a bad thing. But again, as a dividend investor, you kind of just watch that a little bit closer. So now that I know that, $229 million in cash, okay, I come down to the investing activities. It looks like they had $579 million provided by investing activities. And it looks like that's due to, some other things. So those are pretty, I'm not going to get into too much detail on that right now, but they're pretty close to even with each other. Now here's a section where I look and I say, I don't know if I want to be in this company right now at this moment. There's cash flow from financing activities. And this is $878 million. And the biggest thing that I do not like in this section is dividends paid for common stock, $1.7 billion. They had $229 million in cash flow from operations. So that means they're paying out roughly, what is that, about, trying to find that number again, about 1.5 billion, billion in dividends that they don't have the capital for. So what they're having to do, it looks like they had about $3 billion proceeds from long-term debt. They had $1.5 billion from the issuance of commercial paper. And that's about basically where they're at. Looks like they ate into their cash position a little bit. And again, that's to finance their dividend position. So me as a dividend investor, I look at something like this, and this disqualifies this company right now, at least as a dividend payer, somebody that I want to own long term. Again, that doesn't mean anything against their growth prospects. I have another growth prospect analysis that I put people through. But as far as specifically for a dividend payer, I would not get Kraft Heinz into my portfolio at this present time, mainly because they're financing their dividend through borrowing of debt, which again, they can handle the borrowing of debt, but it makes me wonder as a dividend investor, if they don't have the cash flow to finance it, are they going to keep that dividend going? So for me right now, I'm not going to invest in KHC as an add-on to my dividend portfolio. So that's kind of the analysis. And again, I was thinking about writing up a blog post, but I figured, hey, maybe I get my face out here on the internet and talk to all you great people. So if you have any questions, comments, let me know. Direct message me. Leave a comment below. I'll get back to you as soon as I can. Otherwise, again, upward and onward towards financial freedom. See y'all later. Take care.